A merchant is paying 2.9% on every transaction. Their competitor is paying 1.4%. Same card type, same product, same volume. The difference? One of them understands how payments pricing actually works. The other one signed whatever contract was put in front of them. There is no single pricing model in the payments industry. There are at least 5. And inside each one, there are fees most merchants have never even heard of. Auth fees, assessment fees, chargeback fees, cross-border fees, batch fees, PCI fees. Each one is a line item on a statement most merchants never read. Today, we are going through all of them, every single one. By the end of this video, you will never look at a merchant statement the same way again. The first model is flat rate pricing. This is what Stripe charges, what Square charges, what PayPal charges for most merchants. 2.9% plus 30 cents on every transaction. Period. No surprises. No monthly statements with 40 line items. One number. Here is why merchants love it. It is predictable. You sold $10,000 this month. You know exactly what you paid. $290 plus fees on each transaction. Here is the problem. Flat rate is almost always the most expensive model at volume. That 2.9% is not what it costs to process the transaction. The actual interchange cost on a basic Visa debit card is around 0.8%. Stripe keeps the spread. Square keeps the spread. They profit on the difference between what the network charges and what they charge you. For a startup doing $5,000 a month, flat rate is fine. For a business doing $500,000 a month, flat rate is a tax on ignorance. The second model is Interchange Plus, also called Interchange Pass-Through, also called Cost Plus. This is the most transparent model in the industry and the one every high-volume merchant should be demanding. Here is how it works. Interchange is the base cost, the fee the card network sets that goes to the customer's bank. It is not negotiable. It is not markup. It is the floor. The plus is what the processor adds on top as their margin. So a deal might look like interchange plus 0.20% plus 10 cents. Why is this better? Because you see exactly what the card network is charging and exactly what the processor is charging. Separately, there is no spread being hidden inside a flat percentage. If interchange goes down, your cost goes down. If interchange goes up, which it does when customers use premium rewards cards, you see exactly why your bill went up. Adyen charges Interchange Plus. Braintree offers it. Most enterprise processors offer it. It requires a slightly more sophisticated merchant to read the statement, but it rewards that sophistication with significantly lower costs at scale. The third model is tiered pricing, and it is the one you need to watch out for. Processors who use tiered pricing group transactions into 3 buckets: qualified, mid-qualified, and non-qualified. Qualified is the cheap tier, a basic debit card swiped in person. Non-qualified is the expensive tier, a premium rewards card keyed in manually, a corporate card, a cross-border card. Here is the problem with tiered. The processor decides which tier your transactions fall into, and they have a financial incentive to downgrade as many transactions as possible into the higher tiers. You can sign a contract showing a qualified rate of 1.7%, and then find that 60% of your actual transactions are being charged at 2.9% because the processor classified them as non-qualified. Tiered pricing is not necessarily fraud, but it is deliberately opaque. Avoid it if you have leverage. Now let us go through the individual fees that appear on every statement regardless of your pricing model. First, the authorization fee. Every time a card is presented for payment, whether the transaction is approved or declined, the processor charges an authorization fee, typically 3 to 10 cents per auth. Think about what that means. A merchant with a high decline rate, say an online business with lots of failed payment attempts, is paying auth fees on transactions that never even converted. In high-volume environments, auth fees alone can add up to thousands of dollars a month. It is a fee most merchants do not notice because it is buried in the statement as a per-item charge. Second, assessment fees. These are charged by Visa and MasterCard directly, not by your processor. They are not negotiable. They are not markup. They go straight to the card network. Visa's assessment fee is currently 0.14% on credit transactions. MasterCard is approximately 0.13%. On $100,000 in monthly volume, that is $140 going directly to Visa. It does not sound like much, but it is a pass-through cost that is on every single transaction, every month, forever. The processor has zero control over this number. If a merchant ever asks you why their bill went up, check if the card networks just raised their assessment rate. They do it quietly, and most processors just pass it through without explanation. Third, chargeback fees. A chargeback happens when a customer disputes a transaction with their bank instead of contacting the merchant directly. The bank claws the money back from the merchant while the dispute is investigated. The fee for receiving a chargeback is typically $15 to $25 per dispute, charged by the processor, regardless of whether the merchant wins or loses the dispute. And here is what most merchants do not understand. You do not just lose the sale amount if the customer wins. You lose the sale, plus the chargeback fee, plus in some cases the original processing fee is not refunded. On a $50 product, a single chargeback can cost the merchant $75 total. For certain industries, travel, digital goods, subscriptions, chargeback rates are a make-or-break metric. Which brings us to chargeback rate. And this is the one that can end a merchant's ability to accept cards entirely. Chargeback rate is the percentage of total transactions in a month that result in a dispute. Visa's threshold is 1%. MasterCard's is 1%. If a merchant's chargeback rate exceeds 1% for 2 months in a row, they get flagged. They enter a chargeback monitoring program. Fees increase dramatically, sometimes $50 per chargeback or more, and if the rate does not come down, Visa or MasterCard can terminate the merchant's ability to accept that card network. This is why fraud prevention is not optional. It is existential. Let us go through the remaining fees quickly. Monthly minimum fee. If you do not process enough volume to generate the processor's minimum revenue threshold, they charge you the difference. Typically $25 to $50 a month. PCI compliance fee. Merchants must meet payment card industry data security standards. Processors charge $100 to $300 per year for PCI compliance management. Non-compliance fees if you fail a scan, up to $50 a month. Batch fee. At end of day, when the processor settles transactions, many charge a batch fee, 5 to 30 cents per batch. Small, but it adds up at volume. Cross-border fee. Any card issued outside the country the merchant is in carries an additional fee. Visa charges 0.4% on cross-border transactions. For an e-commerce merchant selling globally, this is a significant line item. Currency conversion fee, separate from cross-border. If the merchant lets customers pay in their home currency using dynamic currency conversion, the merchant pays an additional 1 to 3% for that service. Card not present premium. Online transactions carry higher fraud risk, so the interchange rate is higher than in-person transactions on identical cards. A Visa rewards card swiped in person might cost 1.65%. The same card entered online, 2.1%. Every e-commerce merchant pays a silent premium just for being digital. So, which pricing model is actually better? The honest answer, it depends on 3 things: volume, card mix, and operational sophistication. Under $20,000 a month in volume, flat rate wins. The simplicity is worth the premium. You are not processing enough for the spread to matter. Between $20,000 and $200,000 a month, start asking about Interchange Plus. The savings will outweigh the complexity of reading a real merchant statement. Above $200,000 a month, Interchange Plus is almost always the right answer. Full stop. At $1 million a month, the difference between flat rate and Interchange Plus can be $8,000 to $15,000 per month. Tiered pricing, almost never optimal. The only scenario where it wins is a merchant with an extremely consistent, low-risk, card-present transaction mix who negotiated an aggressive qualified rate. Otherwise, it is a trap with a clean-looking headline number. The best sales rep in the room is not the one who has the lowest rate. It is the one who can read a merchant statement, identify what they are actually paying, and explain exactly where the savings are. That is the difference between a rep and an advisor. Terminal IQ. One concept like this every single day. Follow the channel.